Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia Derivatives Bhd and managed by LifeChamp. Today, we are very excited to be doing this topic that is titled How to Trade BMD's First Exchange-Listed Inter-Commodity Futures Spread, which is FCPO and FEPO Inter-Commodity Spread. So that is the title for this webinar. Now, this webinar is designed to be a little bit more advanced, but rest assured, we will go through, what is the basics of inter-commodity future spread with you today, so you know how do you trade these newly listed exchange traded products. All right, so welcome to this session. Now, before we begin, as usual, a disclaimer. Whatever you share in this webinar is only for educational purpose. So in no way that we give you any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions or any trading decisions, you're entirely responsible for all your investment and trading risks. Now, it gives me great pleasure to introduce our speaker today. And he is the founder of Kelvin Grayson Assets Bhd, a proprietary trading firm and an associate participant of Bursa Malaysia Derivatives Bhd. He is an investor, quantitative robot builder, and an entrepreneur after years of working in multinational and public listed companies. He is a certified information system auditor by ISANA and a project management professional with Project Management Institute. He has been investing for more than 20 years and has been trading both local and foreign futures for more than 6 years. He's a technologist turned professional trader. After 20 years of investing, he regularly shares his market insights and experience with investors group. He is also the author of a technical analysis book, Profiting from Any Market. Now, Kelvin holds a master's degree in advanced computer science, specialized in artificial intelligence from University of Manchester. So, ladies and gentlemen, so let's give a warm round of applause to welcome our speaker today, Mr. Kelvin Chin. All right, Kelvin, welcome to our session today.
Yeah, thank you. Good evening, everyone. First of all, I would like to thank you, Bursa Malaysia and LifeChamp for the invitation to make this sharing possible. So I think without further ado, I will start sharing my slide. Okay, is everyone able to see my slide?
Yes, I can see your slide right now.
Okay.
Wonderful.
So we shall start the presentation. Okay. Shane has done the disclaimer, so I will not do it again. Okay, so we go straight to the agenda. Today, our topic is how to trade BMD, first exchange traded inter-commodity futures spread. Okay, so first of all, the first item we will touch on what you will get from this talk. Then after that, the second item I will skip. Who am I? Because LifeChamp Shane already has done the introduction, and then we'll go straight into the third agenda, intro to the inter-commodity, and then after that, FCPO, FEPO in brief, and what is the benefit of trading using this in product. Then the fifth, we'll go into the price trend and behavior of inter-commodity spread. Sixth, we will go into strategy to capture each of the price movement. Then we will move on to the spread trading workflow. This will be my workflow. So everyone can agree or not agree. Everyone have their own opinion. Then lastly, we'll go into Q&A. Okay. So what we will get from this talk? So you will learn my way of trading inter-commodity spread, intro, new product, FEPO and FCPO and FEPO exchange traded spread. So this talk might, I will expect a little bit of experience in the future trading, future contract trading, but beginner may benefit from it as well. So in the process of this webinar, if you have any question, you can ask in the Q&A section. Okay. So in this webinar, there will be a few questions I will be asking you guys. I will need some of your feedback or maybe some interaction from you guys, so to make this webinar is more interactive. Okay, so hope you guys can give me this cooperation. So okay, so this one myself, so I will skip this one because just now Shane already done it. Okay, so what is intercommodity spread? So intercommodity spread is basically buy a related commodity contract and sell another related contract, normally at the same time. Okay, can be different time, but normally you will be at the same time. Okay, then in theory, these two commodities should move in tandem. Whenever there is they didn't move in tandem, then we call it there is an inefficiency happen. So we will exploit this inefficiency to get the profit. We're hoping that this inefficiency is temporary, and then after that it go back to normal. So with this, we will be able to get some profit. Okay. Okay. Example. Okay. Buy the February FCPO contract and sell February FEPO contract. So this will be an example of intercommodity spread. Okay. But for today's, we have an exchange traded commodity spread, intercommodity spread. That means we can straight away do it by using one transaction. Okay. Then the last point is trading the change of the net difference between the two contracts of the different product. So we are trading the net difference. So, okay. So basically, in other words, is the inefficiency of the two spread. Okay. Okay. So we go into this introduction of FCPO and FEPO. So FCPO and FEPO spread, in short form, I call it CE spread. C is FCPO, E is FEPO. It's a tool for trading on the relationship between the FCPO and FEPO. So CE spread exploit the price relationship of the different supply and demand dynamic of West Malaysia CPO and the East Malaysia CPO. Okay. Then CE spread buy and sell of underlying FCPO contract and FEPO contract of the opposite direction at the same time, meaning that if we are buying we want to buy this spread, FCPO, FEPO spread, meaning that if we will buy the FEPO contract, the underlying contract, and then at the same time, we will sell the FEPO underlying contract. So these two action is all done by just using one exchange traded contract. Okay. So if you want to do a opposite direction, is a sell. So you just sell the FCPO, FEPO intercommodity spread, then it's equivalent to you sell one FCPO and buy one FEPO outright. Okay. So how does the FEPO and FEPO spread derived is basically is FCPO minus FEPO. Then you get the spread. Okay. So next thing, let me move a little bit. Okay. So what are the differences between the FCPO and FEPO spread and the existing calendar spread? Calendar spread meaning the FCPO calendar spread and the FEPO calendar spread. So basically, we FEPO and FCPO and FEPO, we do any two-leg combination of first 6 continuous months. That means from the spot month until the 6th month, you can mix any 2 legs. Okay. Then cross month is allowed. Cross month, that means different month. Total combination is 36 combinations. Okay. Launch is already launched. Okay. So basically we will treat this spread as normal, as normal calendar spread. But we are dealing with 2 different contracts, 2 different product contract. Okay. Okay. Sorry, let me see. I think jump slide. Okay. Next one is why trade exchange traded CPO and FCPO and FEPO spread. Limit the risk of slippage due to the time difference between order entry or execution. So if, let's say, for example, we don't have this intercommodity spread. So if we want to open intercommodity spread, first we will need to go to place an order, let's say buy order in to buy a FCPO, and then we will need to quickly create a sell order to sell the FEPO to create a FCPO and FEPO spread. So, but we are human, so we cannot do it that faster. So this FCPO and FEPO intercommodity spread will solve this problem. So once you buy or sell using this exchange traded intercommodity spread, you will create this combination at the same time. Okay. Then avoid broken leg. So avoid the chances of broken leg, meaning that if we buy one contract at using FCPO, and then suddenly the price jump, or then we cannot get the price that we see original see. That means it's pulled away from what we see. So we call this a broken leg. Okay. Avoid if another alternative is we can subscribe auto spreader software. Auto spreader software, meaning that you can configure to buy to configure a spread, any contract that you want to mix, you can configure it. So once you configure it already, then you can say, I want to buy this spread. Then the system will go to buy the individual leg. Okay, buy or sell individually. So buy the software. So, but this software costs money. So this FCPO and FEPO intercommodity spread to help us save a little bit of money. Okay. And then exchange traded spread is a separate contract. So this exchange traded spread is actually a separate contract from the outright. So with this outright and the contract spread, we also can exploit inefficiency. So meaning that there is arbitration possibility that you can catch. Okay. Okay. Next, let me see. Okay, how the spread is defined? How the spread is defined? Let me see. Okay. So from here, you can see the FCPO. Okay, G is February contract is at 4,600. Then we have this FEPO G contract at 5,620. Okay. So to create a intercommodity spread, so basically it's the FCPO minus the FEPO. Then you'll create the intercommodity spread. So this intercommodity spread, we already have a exchange traded intercommodity spread. So as the result, then we have this bottom chart come out. Basically, this will be the intercommodity spread chart. Okay, so in here it should be minus 1,020. Okay. Okay, another example. So basically, same formula. FCPO minus FEPO, then you get the FCPO and FEPO spread. So in here, because the price movement is closer to each other, then you get a smaller number. So you can see how we can profit from it. Let's say, for example, in here, you see that the price is very low, because maybe you can justify that because this price is in May is low point and in March is low point, and now June also have a similar low point, so you buy minus 1,020. Okay, then today maybe the price move closer. So right now the code is 123. So actually you make a profit. Okay, 1,000 plus point profit based on this example. Okay. So far so good. So we already done the FCPO, FEPO introduction and what is it? Okay. Okay, so we'll move into the next section, which is the price behavior and the trend of any spread. But for today's topic, I will focus on intercommodity spread. Okay, the example will be in an intercommodity spread. But this same principle can apply to any spread. Okay, a spread, basically we are trading the price difference of the difference of the two contracts. Okay, so from here, you can see there are few combinations that can happen. Okay, so the first thing we need to learn is spread widening. I mean the spread is widening. Okay, so you can see here. Okay, widening now. Okay, so you see the two line is expanding, so we call it widening. Okay, so this is the first term that we need to learn. Okay, next is narrowing, meaning from the long line to a shorter line. Okay, it's narrowing. Okay. Okay, the next one we need to learn is flat. Flat means not moving anywhere lah. So meaning from the from this to this, actually the length is the same. Length is the same. So we call it flat. Okay. Okay. So assuming the upper one this upper one is leg one. Leg one. This one is leg two. Okay. We are trading the differences between these two contracts. The relationship is either is widening, narrowing, or flat. Okay. So you can see we have a few combinations here. First is this one go up, this one go down. So widening. Or next one is this one come up, this one go down, is narrowing. In another scenario is this one flat, okay, but the leg two is dropping. So meaning we got a widening as well, even though the first contract is maintained, but the second leg is going down, so it widened. Then the next one, example, is narrowing. Even though the first leg is flat, but the second leg going up. Okay, so the spread will narrow. Okay, so this one is another example, up, flat. So you will get a spread widening as well. Okay, this one come down, same thing. It even though it come down, but the length is maintained. So meaning even though the leg one and leg two come down, but their relationship is maintained. So meaning that the spread is not moving. So maybe 20. After move down, also keep it as 20. Okay. Then next one is narrowing. That means from here to here, the line is shorter, it becomes shorter. So this is narrowing. Even though the first leg is maintained, the same price, but the second leg come up, so we get a narrowing. Okay. Okay. Next is this behind section, this section behind is all maintained because the length is the same. Even though the price is moving, but the relationship maintained, meaning that you will get the same spread number, let's say 20. Okay. So even though the price move, okay, so spread has this relationship. Okay, so you have to be familiar with the relationship. Then, okay, right now we say, okay, if the price not trending, that means it's sideways, but they have this inefficiency up and down, then we will get this graph. What if we have a trending one? So if we have trending one, so it's the same graph, but it's sliding up. Okay, so it's trending, and it can be slight spread also can slide down, downtrend. Okay, it can go downtrend. Okay, so we have to be flexible when we look at the spread. Okay, Okay, this is the price example. Just now that one is the theory. Okay, so from here, you can see, let me change the color. Okay. From here, let's say from here, we can say, we assume it's here. Okay. So when it become widening, okay, widening, so it come down. Okay. Then it become narrowing because it become narrowing. Then it go up. Okay. So the widening narrowing relationship can be one flat, one half circle or so. Okay. So it makes this price movement. This is how it makes this price movement. And then if we have this, we call it flat spread. It means the number doesn't change, but the price change. So it's like this here, here. Change one color. All this level, this level, this level, your spread, leg 1, leg 2 should be something like this. So it doesn't, at the net result, it doesn't move anyway. But actually the leg is moving. Leg is moving, but the net result is not moving. The spread is not moving. Okay, then we come down to here. The spread is trending. Spread is trending is, let's say, assume here is here. Okay, then it widening. Okay, widening. So it shoot up. Okay, then it in here it narrowing. So it's retrace. So from the graph you will see like this. Okay. So we are trading the relationship, the inefficiency between the two contracts. Okay, so this is spread trading. Okay, next. Okay, so this will be a little bit of intense because a lot of numbers to calculate. Okay, so the strategy to capture each of the price movement. Basically, we have 3 price movement. One is uptrend, one is downtrend, the other one is sideways. So we'll look at it now. So you can see if the spread is up, sorry, if the outright is up and the spread is up. Okay, normally the spread will from point A to point B. That means is widening. From the chart you will see it's going up. The spread is going up. Okay, how many cases we can see a spread go up? So in here I show you 5. One is the first leg up, but the second leg maintain. Okay. Okay. The night market is open. Okay. Then the next one is leg 1 is up and leg 2 is going down. Also is a widening. Then the third one is the first leg is flat maintained, but the second leg go down. Also is widening. Then the fourth case is the first leg go up more than the second leg go up. Also is widening. Or you first leg drop less than the second leg, also is widening. Okay. So in here I give you numbers example. Okay. Let's say for example now, this is now Okay. Now, leg 1, leg 2, spread. Okay. So leg 1 is 441. Leg 1 is 441. And leg 2 is 4755. Okay. The spread will be 126. The leg 1 minus leg 2, then you get spread. Okay. Then after a while, maybe the spread widen. Okay. Widen. For this case is the first one go up, the second one maintain. So the first one go up to 4,900. The second one maintain at 4,755. So you will see the spread go up. Okay. So in the second case is the first one go up and the second leg go down. Okay, from here you use the same starting point 4881 4755 minus get a spread 126. Okay, so the first leg go up 4900, go up to 94900. The second leg go down 4740. So the spread is 160. So at the end we get a widening. Okay. Okay. The second one, the third one is the first leg is flat and then the second leg is down. Okay. So same example, 4881 4755, spread is 126. Then the first leg maintain 4881. The second leg go down 4730. So the net spread is 151. So you also get a widening. Okay. Then the next example is the first leg go up faster than the second leg. Okay. So you can see that the first leg go up to 4950. The second leg 4790. Both also go up, but the first one go up more than the second one. So you also get a widening. So in this example is 160 from 126 to 160. So you also get a widening. Okay, last one is drop. First leg drop less than second leg. You also get a widening. Okay, so first leg you drop to 4850. Okay, then the second leg drop to 4700. So you also get a spread widening. So you can see that even though the spread drop, but the outright is dropping, but the spread is going up. Okay, so there is a difference between trading outright and the spread. Okay. Okay. Question. I need your participation. So this question is, when spread widening increase in price, what should you do? Can you type into the chat box then? Okay, let me see. One, buy. So obviously it's buy. Okay, I think most of you get the answer. Okay, good. Next. Okay, now we go to the next one is spread when go down. Normally spread go down outright should go down. But that is normally normally, as just now we have discussed, there's not always been the case. Okay, but normally it's like this. Okay, Then what happened is the spread will from B point to C point. That means is narrowing. So when spread drop, it's because the spread narrowing. Okay. So in here, I also show you 5 scenarios which can get spread narrowing. Okay. So the first one is the first leg drop, but the second leg maintain. Then you will get a narrowing. The next example is the first leg drop, second leg go up. You also can get a narrowing. Third one is first leg maintain, but the second leg go up. You also will get a narrowing. Then the fourth one is the first leg drop more than the second leg. Obviously, you get a narrowing as well. Then the last example here is first leg go up less intense than the second leg. That means second leg is go up faster than the first leg. Okay. Then you, in this case, you also will get the spread narrowing. Okay. So this is the numerical example. It's the same number starting 4881 is the price now. Leg 1, leg 2, spread. Yeah, spread. Okay. So 4881, leg 1, 44755, leg 2, spread is 126. So for this case is drop. First leg drop, the second leg maintain. The first leg drop from 881 to 850. Then the second leg maintain at 4755. Then we get a narrowing from 126 drop to 95. Drop 31 point. Okay. The next example is first leg go down and second leg come up, goes up. Okay. So same starting point, but the price movement is the first leg go down, the second leg go up, then you get a spread of 126 to become 160. Okay. Spread narrow. The next one is first leg flat, second leg come up. Okay. So first one is maintained at 4881. The second leg is goes up to 4790. So you will see here, we also get a spread narrowing. Okay. Then the next one is the first leg drop more than the second leg. So you see here from 4881 drop until 4800, drop 81 point. And then the second leg is 4755, drop to 4750, only drop 5 points. You also get the spread narrowing. Okay, narrow from 126 to 50. Okay, drop 76 point. Okay. The last example here is the second leg go up faster than the first leg. So the first leg goes up only 9 points. 4881 go up to 4890 is 9 points. The second leg is from 4755 to 4820. So let me see, 45 plus 65 point. Okay. So at the end, you get spread narrowing from 126 to 70, drop 56 point. Okay. So this is spread narrowing. Okay. The outright can go up, go down. But this is not important to us. The important is the leg 1 and leg 2 relationship. Which one go faster than the other one, or they stay maintained in sync. That's more important for us doing spread trading. Okay. We have another question again. Okay. I will need your participation. When spread narrowing decrease in price, what should you do? Okay. The first one is buy, second, sell, third, wait and see, fourth, ask your friend, fifth, throw a dice. So in here, I can see the numbers of response. It's 2. So it's correct. When the spread narrow, you should do a sell. Okay. Now we go to the last market structure, which is flat. So flat normally outright and is not moving anyway, like sideways like that. Then your spread also not moving, not normally is like this, but not always, normally like this. It's like this, go up, but they go in sync. So you will see the spread not moving. So they go down also in sync. Okay. So you will see the spread is not moving, but actually the outright is moving. Okay. So in here, I have 3 scenarios here. You see, first one is the leg 1 not moving and the second leg not moving. This case is very, very rare because CPO price always moving. Seldom is not moving. Okay. So the second case is both also drop, leg 1, leg 2 drop, but they drop in sync. Okay. So you will get a flat edge. The spread is, you will see the spread is not moving as well. Okay. So the third case is both leg goes up in sync. Also, you will see the spread is moving, but actually the outright is already moved. Okay. So we will go into this numerical example. Okay. Yeah. Okay. So 7 starting point. This is now leg 1, leg 2, spread. Okay. So if now and later also same numbers, obviously it's not moving, but this case is very rare. This is very rare. Very rare. Okay. The second one is both also drop, but drop in sync. It means from 881 drop into 851, and then the second leg from 755 drop to 725, meaning 30 points. So both also drop 30 points, then you will see the spread not moving. So you will see the spread not moving. So you maintain as 126. Okay. Next example is both up, but also is in sync. So you will see also no difference. The spread numbers are also same, 126. Okay. So this is the market structure and the field scenario which will happen when the spread is not moving. Okay. Okay. So we come to another question. This question is, when spread not moving anyway, price stay where it is, what should you do? Wait and see. Okay, wait and see. Okay, wait and see. Good. Also, it's one way to do it. Okay. So, okay. Later I will show you another way. You will see whether it will make you clicks or not. Okay, later. Okay. This is my workflow. Okay. To trade this spread. Okay. Okay. My workflow is I have a few steps. I follow this few steps every time I place a trade. Okay. Hold on. What should I do? Okay, let me see what should I do. I think I pressed the wrong button. So I will get out the slide and then come in again. No, hang on. Okay, we are back to the business. Okay. First step, identify the market structure. Okay, so obviously is an uptrend because higher low, it break out here is higher high. Okay, higher low, higher high in here. Okay, let me draw. Okay. Okay, this is up. Okay, this is up. So when we see this is up, then we can start drawing the trend line. But the trend line, it might not be, initially it might not be like this. Initially it might be like this. Like this. Okay, but still is an uptrend. If drop back, then we can cut loss. Okay, but at this moment we assume it's uptrend. Okay, then you have two entry points. One is during this breakout. The second one during retrace and go up again. Two entry points. Okay. But right now only the first step. It means we got hope. We got hope the price will go up. But no entry yet. Okay. We need a few more steps. We need to draw a middle line. Okay. And then after that, we identify the stop loss. Okay. If the price go beyond this level, then we stop loss. Okay. The fourth is the long-term trend. The long-term trend is up or down or sideways. Okay. So in this case, it's trending up. So we can entry here to break out. Okay. We can entry here. We can entry here once it goes back to midline and go up. Okay. Okay. But if you entry here, your stop loss should not be too far away from where you entry. Okay. Okay. Here also is an entry point. Okay. But here is the cut loss. Okay. So how we operate? Assume we buy a spread. Spread number one. We buy spread at 20. Okay, minus 20. Then right now price is 20 lah, because I just buy, so it's 20. Same price. Then I need a stop loss. So I place a stop loss at minus 25. 5-point stop loss. So the underlying leg C is FCPO. For this example, E is FEPO. So I use intercommodity spread contract to create this spread. So assume we get these two leg, okay? These two leg, buy, sell. So we get a 20. Okay, this underlying leg. So price move up to minus 15. Price move up to minus 15. So my spread earn 5 points. My spread right now is minus 15. I earn 5 points, and it doesn't hit my stop loss. So I close it. So I earn 5 points. So this is how you trade an uptrend. Okay. Okay. Next, we talk about sell. Same process. Identify market structure first. It's downtrend. Next is identify the midline. Third is identify the stop loss level. Fourth is identify the long-term trend. Long-term trend is sideways, so you have to use sideways method to do it. And enter when breakout. Okay, so when sideways in an upward zone, you sell. And a lower zone, you buy. Okay, basically buy low, sell high. Okay, so for example, here like this up and break. First sell point, second sell point, third sell point is whenever you reach back this green line, the short-term trend line. Okay, so if you want to do it near the midline, then your stop loss should not be too far away. It should be here. Okay, once it's break your stop loss, you cut to get a few win and then one cut. Okay, but still win. Okay, so we use numerical example to talk about this setup, how to operate. So we buy an intercommodity spread at this time is not buy, this time is short. This one is short. Go downtrend. So example is I short 20. My stop loss is 15, 5-point stop loss. C is FCPO, E is FEPO, leg 1, leg 2. So when I short, then I short the FCPO and buy the FEPO. Okay, so the spread is minus 20. When the price, the spread goes down to minus 25, I got a 5-point profit. Okay, it doesn't hit my stop loss and go down to 25. I get 5-point profit. So I close it. Okay. So this is how we do a short in a downtrend. Okay. Next, getting more excited. This in example would be more intense. Okay. Just now, a lot of people say, okay, during sideways, wait and see, and so on. So the question is, during sideways, when the spread is not moving, can we squeeze some profit out? Okay. Now I will show you how to do it. It will take a higher risk, but you will get the reward as well. Okay. But it depends on your own risk profile, whether you want to do it or not. Okay, same method. First step is identify the trend. For this case, is a sideways. We draw midline SL and the long-term trend. For this case, I assume the price move up first. Okay. Okay. We will use a numerical example to illustrate this example. Okay. So same thing, we have to start with something. So we will buy one intercommodity spread ICS, intercommodity spread at -20. Stop loss 25. Okay. Assuming it maintained at 20, but the leg, you can see the leg already move. Last already moved from 6020 move to 6520, and this one move to 6540. Even though the spread maintained, but the leg already moved. Okay, for this case, if you see this scenario, meaning that you see a downtrend pattern, that means this is resistance, lower resistance, and it breaks the previous low here. So you can assume that the price already make a reversal down. Okay. So when price make a reversal down, you take the long profit, the leg one, you close it at current price. So you will up 500 points. Okay. Maintain the leg two. Okay. But you put in a stop loss just in case it goes against you. Okay. So for this case, I use 5-point stop loss. Okay. The stop loss, it depends on situation. You can set your own. Okay. For this example, I will maintain as 5 points. Okay. Next, another type. Okay. Maybe the first one is 1 p.m. The second one is 2 p.m. The third one is 3 p.m. Okay. The spread still maintain -20. Okay. But the leg already moved. Okay. You see the leg already moved to 6440. 6440. Then this one move to 64. Sorry, not okay. A is leg one. Leg two. This one leg one because we already close. So no more. Okay, we already take profit 500. Okay. Now because we see another reversal point. Okay. Resistance as support, higher support, breakout. Then we see a reversal point here. Then we recreate the leg one. So right now it's 6420. So we buy one contract here of FCPO, one contract of FCPO leg one. Then we reconstruct these two. We reconstruct this spread. Okay. Once we reconstruct this spread already, then we delete this stop loss. Okay, we delete this stop loss. We put in the spread stop loss. Okay, because it becomes spread already, so we put in the spread stop loss. Okay, so in this case, you see the P&L. You'll get 100 points with the spread not moving, or maintain 20. Okay. Next example. This one it happened to goes up first. Then next example is we'll talk about once you entry, it goes down. Okay. Same method. Okay, the 4-5 method, 4-5 steps. Okay, same case. We start with long one spread at 20, stop loss minus 25. Of course, we have the leg here. Maintain 20. Okay. So, but this time the spread the leg the outright go down. Okay, go down. But the spread maintain minus 20. So we see a profit for our short position, which is at for FEPO side. So we will close it and take this profit, and then we put in a stop loss there for the leg one. Okay, and this one no more stop loss already because it become outright trade. Okay, so let's see here. Why we can say we can do this? Because we see a reversal pattern from here to here. Okay. Next is after you have done the second step and you see another reversal, but this time is in the opposite direction. So you reconstruct the spread. Okay. The step reconstruct the spread is you sell back the second leg, then you will get the spread. Okay. Okay. You get the spread now. This is one example, but after it depends on which price you have take profit, then you have to adjust accordingly. But this is an example. So for easy illustration, so we maintain at minus 20 and our stop loss maintain at 5 points away from the entry point. Okay. Okay. The net is, even though we haven't the net here, even though we haven't closed the position, but right now we should see 100-point profit. Okay. Okay. So enough numbers, theory, and calculations. So we ask the last question again. When the spread not moving anyway, price stay where it is, what should you do? So please type your answer in the chat box. Can anyone share the answer? 1 and 2, buy, sell, buy. Okay, that means you make some transaction. That means you initially we say each many answer saying that it's a wait and see, but right now you see opportunity. Okay, so that is some improvement there. That's good. Okay, but this method is not suitable for everyone. Okay, it comes with higher risk. Okay. Okay, so I think I'm going into the end of this presentation. So the last slide, take home slide is exchange traded intercommodity spread like FCPO and FEPO spread is a cheaper and safer way to trade instead of building it from outright. Intercommodity spread is another tool to add to your spread trading toolbox. And the last point is it allows you to take advantage of the price deficiency of two related products. Two related product in this case is FCPO and FEPO. Okay. I think that's all my slide. Back to you, Shane.
All right, thank you so much, Kelvin, for doing this inter-commodity spread trading session for us. So I guess many of you here would have understood, what exactly is this inter-commodity spread between FCPO and FEPO. Okay, so essentially it is the price difference between the crude palm oil price in East Malaysia and also in the West Malaysia. All right. So I think today, Kelvin also shared with us, some advanced trading strategy and how we can close one leg and open the other leg depending on how the market move. I think today we have learned a great deal from you, Kelvin. So if you have any questions to ask our speaker today, you may write in the Q&A box. All right, and we'll address them accordingly. Mose would like to ask, which spread are more interesting or exciting to trade? Is it calendar spread or is it inter-commodity spread like you show?
If you're more active, I think right now is the FCPO calendar spread.
FCPO calendar spread.
FCPO calendar spread. Not just calendar spread. Butterfly also is quite active.
Quite active lah. Okay, so all right. So in calendar spread, right? Calendar spread, let's say FCPO. Negative would mean contango, right?
No. The calendar spread is the concept of contango and the backwardation. It is not limited to spread outright as well. So basically, contango or backwardation telling you is the relationship between different contract months. Okay. So for example, if the future price, that means the later month is the price is higher than the spot month. That means we call it as a contango. The backwardation is the other way around. So basically is the future price is lower than the spot. Okay. So I think just now the question maybe got a little bit of misunderstanding of this concept. Okay.
The next question is, how to choose which spread contract month is the best?
Okay. When choosing, there are different people, they use different method. Okay, for me, you can start with the forward curve. That means the just now the person asked about the question about contango and backwardation. So for this, you plot a forward curve. So if you see a forward curve is that month is going up and your opinion is the market is going up, then you just choose that contract. That's how I do it. If the market, if the forward curve at some point is going down, and maybe example is March start to go down, then you can choose the March or February contract to do a short. So you can use the forward curve to guide you to choose which contract.
Okay, so sometimes you do a very far month, sometimes you do very near month. Am I right, Calvin?
Yeah.
This depends on the how the forward curve
actually,
is like.
every month I also do.
Okay.
All the contract month I also make.
All right. So let's come back to these inter commodity spread, right? So may I go to the most fundamental question? How come there would be such a huge difference between the price in East Malaysia and in West Malaysia? Like just now we saw that there were times where the difference is like 1,000 ringgit.
Because at that time I take the numbers is during early day it just launched not far away. I think it's because of illiquidity so less participant coming in so but once you can see the chart just now, the price goes closer right now. So meaning that the as the price as more participant coming in, the price should get closer. Okay, basically the two price why it fluctuate it depends on the different opinion of these two group of traders. So one group of traders, maybe FCPO or CA, think that should go higher. Then maybe FCPO maybe a higher but not that much. Okay, so they have a different opinion. Then you will get this spread up and down.
Usually the price in East Malaysia or West Malaysia trade at premium to the other.
No, in theory yes but in market we cannot say it's confirmed. In theory it should be because people will justify that okay the transport fees and so on but we still based on chart to trade.
So you mean East Malaysia usually is more expensive, right?
Normally it caught a lower price.
So East Malaysia palm oil is slightly lower West Malaysia is slightly higher.
Okay, yes.
Okay, so that's under normal circumstances So that's where the
theory
in
theory but okay. we don't follow this theory.
Okay, so when we do inter-commodity spread, right? Usually, like we compare FCPO and FEPO, right? Usually it's the same contract month, is it? Like February versus February.
Okay, normally we can normally we will do it this way because it's more active. But as I just now I said, you can combine any 6 months from spot month plus, let's say from January until June. Each of them they have their the inter-commodity spread, and then you can mix the leg. In total, you have 36 combination. That means you can mix leg January, February, or January, or January, March, or something like that. You can mix and match. It depends on your opinion.
Okay, thanks for clarifying. Charlie would like to ask, what kind of risk is engaged in this type of inter-commodity spread trading?
You have to make sure that both have the liquidity that you can get in and out.
Okay. Lee would like to ask, are you able to do a live trading example? Since the
Not for
market
today
now
lah.
is
Not for today
open.
lah. Maybe in the future.
Okay, not for today lah. Maybe in the future. Okay. Okay, so you have more questions to ask our speaker today. Yeah, just write them in the Q&A box. Okay. How long has this inter-commodity spread been launched? Yeah.
Launched in October. Newly launched only. So it's a new product.
What is the margin for this futures contract?
Margin, I think it's better check with your broker.
Okay. Andy would like to ask, which platform do you use for your trading?
I use QST.
QST lah. QST also provide inter-commodity spread, right?
Any platform also provide inter-commodity spread lah. Like for example, CQG, TT, J traders, and so on. A lot of platform lah. So it depends. It depends what your broker offer lah.
All right. Ho would like to ask, is this strategy competitive among the traders community?
Strategy wise, I'm not sure what the other party is doing. I only know what I'm doing. So I cannot answer your question.
Okay. Now, is it a common practice that a spread trader will depending on how the market move in the sideways trend, they will close one leg and open the other if there's a reversal signal?
For the advanced trader, yes.
Advanced traders. So today you share with us really solid stuff.
Yeah.
Okay. Okay, any more questions from the floor today? Yeah, today's session is a bit more advanced, okay, because you need to have understanding about futures contract in crude palm oil. Then you need to have a basic understanding of FIPO contract. Yeah, so today we are exploring the newly launched inter-commodity spread futures contract between the FCPO and FIPO. All right. So while we are waiting for your questions, if there are any, let me share with you about the campaign that Bursa is doing while I give you a bit more time to write your questions. All right. Yeah. So in a short while, we are going to have a post-webinar survey. So if you answer our survey questions there, you are going to walk away with Touch and Go e-wallet reload pin worth 30 ringgit. So we'll pick 10 lucky respondents who answer our survey questionnaire. So this survey will be launched right after this webinar and will also be sent to you via email. So we'll reach out to the lucky winners within 2 weeks. So we appreciate your feedback into the session to see how whether this session meet your expectation and how can we improve. Right. So leave us with your feedback. And then we'll pick 10 lucky respondents to give 30 ringgit Touch and Go e-wallet reload pin. Okay. Okay, I see there's one question by Eddie Chiam. How do you repair a trade if a leg in and out did not work?
Okay. Basically, we call it a broken leg trade. Meaning that you try to open a spread, but by doing manually, that means you open one leg, then the other leg. Okay. Normally how I do it is I try not to go into repair. So if I enter a leg, then I make sure that it has a reversal pattern. Then I will treat this trade as outright. Okay. Then I will base on outright method to place a stop loss. Okay. So if it happen to hit my stop loss, okay, then the position is closed. Okay. If it doesn't hit my stop loss, and then I manage to open up at the other leg, the leg 2. Then once I open the other leg 2, then it become a spread already. Then I will delete this stop loss, the outright stop loss. Then I will place a spread stop loss for the entire group. Okay. So always has a stop loss.
Yeah, that is the golden rule in trading. Okay, for capital protection. Now, Kevin, if we close one leg, leaving the other leg open, and we see a reversal pattern, and we open another leg, so do we pay the outright futures trading margin, or is still a spread trading margin?
I think depends on your brokers how they calculate it. But normally when you open one leg and the other leg, then at that time they will calculate as the outright. But once you do settlement, they see a 2 leg, then they will calculate as a spread.
Okay. All right. So check the broker. All right. Keep your questions coming. All right. And in the meantime, let me do some shout out for some campaigns that BMD is doing. So Bursa Malaysia Derivatives has been promoting this campaign that is called Derivative Virtual Trading Challenge 2022. The campaign period is from 7th November to 6th December. So this campaign aims to challenge you in derivative trading. Okay, so you may join this session, join this challenge to test your derivative trading strategy and see if you can emerge as one of the winners or not. There are a total of 40,000 prizes worth, okay, for all the winners. So it is a 1 month trading competition. Yeah, so if you are one of the top few traders, then you'll be able to walk away with the cash prizes that will be sponsored by the Bursa Malaysia Derivative. Okay, so yes, tomorrow is the last day to register for this derivative virtual trade challenge. So if you have an interest to deepen your study into this futures trading, please go to this website, which is www.bursamarketplace.com/DVTC, okay, to register for the Derivative Virtual Trading Challenge 2022. Okay, last year, Bursa Malaysia also organized it, and it was well received. So this year, we open it again for the public to join. Of course, there are 2 tracks. The first track is for the retail investor to trade as an individual trader. The other track is for students. Okay, so if you are students, you may form a team of 3 participants to join the student track. Okay, so you may form a team of 3 persons and join the student track. And tomorrow is the last day to register for this derivative virtual trading challenge. Don't miss it out, because this challenge will aim to elevate your understanding into futures trading and give you a virtual account, using QST platform to trade and to practice your trading strategy. All right. So yeah, we have one more question just came in from Eddie Chiam. Can you explain why the nearby month is carry and the forward spread is inverse?
Okay, so basically how the forward curve is shape up and shape down, it depends on the expectation of the trader for different delivery month. Let's say, for example, in the early month, the right now is early month is a contango, meaning that the price early month is lower than the far month. Okay, so meaning that the the expectation for the delivery, they don't want to pay so much money to get it. Okay, that means low demand. But the far month is still command a higher price. That means the far month demand is higher. So if the further month, the forward curve drop, also the same thing lah. It all depend on demand and the expectation, the trader expectation for the demand of the commodity.
All right. Thank you so much for the explanation, Kelvin. All right. So tomorrow is the last day to register for DVTC. All right. If you have any more questions, please write in the Q&A box. The next campaign I want to talk about is this Trade FM70 campaign. Trade FM70 and win trading competition. If you join this FM70, this is not a 1 month campaign. This is a 4 months campaign started from 1st September to the 1st of December. All right. So the more you trade FM70, this is a real trading account. The more you trade FM70 by the kind of volume, then you'll be able to stand a chance to be winning some of the prizes here. Okay, you can choose one of the 3 categories. One is the sales challenge. That's for the, I think, futures broker representative. The other one is for professional traders. The third one is for retail. Okay, so you'll be looking at the retails. Okay, so the more trader volumes you have for FM70, which is a mini FTSE Malaysia mid 70 index futures contract. So if you can, the more you trade FM70, the more you can stand a chance to win in this retail trading contract. All right. And if you don't want to trade FM70, you can also participate in the FM70 quiz challenge, whereby the quiz will be held on the social media of Bursa Malaysia. And what you need to do is just fill in the Google form and participate in the quiz, and you may stand a chance to win 100 ringgit touch and go e-wallet reload pin. All right. So for more information, you may go to www.bursamarketplace.com/FM70 to know about the campaign details. All right. So the campaign start from 1st September to 31st December. So if you want to learn more about derivative, you may head over to www.sidc.com.my, whereby they have this derivatives e-learning series, DEL, for you to learn a series of knowledge about derivative, okay, futures contract in different futures contract and the trading strategies. So it's a complete course, yeah. And last but not least, before we leave today, I'm going to share with you what is our next webinar, which is titled Mastering Equity Futures, Tactical Tools for Trading and Hedging. So in the next webinar, we are going to look into equity futures, how we can use it for trading and speculation gain. And of course, how can you use it to hedge your portfolio risk? Okay, so we're going to look into how do we master equity futures. So it's happening on 8th November, 8:30 to 10 p.m. It's a Tuesday. So the registration link is here. I'm just giving you the registration link. If you want to learn about how do you use equity futures such as FKLI, FM70, okay, to get speculative gain or to hedge your portfolio, stock portfolio, join this webinar. All right. So this is my last slide. It really looks like there are no more questions to ask about inter-commodity spread. So with that, I would like to express my utmost gratitude to Mr. Kelvin Chin for joining our session today to talk about inter-commodity spread. This is the first exchange listed, inter-commodity spread on Bursa Malaysia Derivatives for these 2 contracts, which is FCPO and FEPO. All right. So if you want to learn more about futures trading, just stay on to our YouTube or to our webinars, where we will bring to you more BMD futures trading webinar series. All right, with that, thank you everybody and have a great evening. Thanks, Kevin.
Yeah, thanks everyone.